Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are talking about hybrid funds and why you probably definitely need to have them in your portfolio. Asset allocation is key. Mohit is with me in the studios and Ehab of ICICI Pru is with us joining in remotely today. So gentlemen, like we've now sort of established the broad categories and the big popular ones as well. Before I talk about balanced advantage or the multi-asset allocation funds, very quickly, Mohit, is there any reason for a low-risk investor, maybe a retiree, maybe someone who doesn't want to take aggressive bets in the market, is there any reason for such an investor to consider conservative hybrid funds? Wouldn't they just be better off in a fixed deposit in that case?
Look, Surabhi, I firmly believe that if you're a conservative, very conservative investor, you should try and seek some portion of your allocation into equity savings category or conservative hybrid category.
Okay.
Now, both these categories suffice different needs. So if you're into equity savings category, the pure equity composition can vary between 15 to 25 odd %.
Okay.
But the remaining composition is arbitrage to take the overall composition of equity above 65, which is the taxation limit. And the remaining composition is...
This is really important. I'm going over this again. So the total equity exposure becomes 65% in the equity savings category.
Absolutely.
So you actually get the benefit of equity taxation.
You get equity taxation, which makes it highly effective as a category.
But it's a safe category of funds.
It's a broadly safer category because you are into predominantly arbitrage and debt portion.
Okay.
The pure equity portion is hardly 10 to 15%. Again, it varies between fund house to fund house, but yes, it's a predominantly a very safe category and gives you equity advantage as in form of taxation. The conservative hybrid category will have equity composition between 10 to 25 odd %, and the remaining portion is debt.
Fully debt.
Yeah, this is more for an investor who's still looking at a 3 to 5 year kind of a view and who wants some element of capital protection built in by virtue of a large debt allocation, but a little kicker of equity. So just a little upside out there.
All right, got it. Makes perfect sense. Now, equity savings, that's a good one to look at because it's tax efficient and it's relatively safe returns, perhaps stable returns. Got it. Now, Ehab, I want to move to your favorite category, which is dynamic asset allocation, where the fund manager has the flexibility, the asset manager, to decide how much equity, how much debt, how much commodities, etc. Right? So let's start with first, BAFs, balanced advantage funds. Now, all BAFs are not similar, right? Different mutual fund houses have their different criteria in terms of what is the algorithm, how much should be equity, when should it be rebalanced. So in general, what are the industry practices and how should I, as an investor, pick the right BAF?
Correct. So see, broadly, the method of managing the net equity level can be classified into two halves. One is one can adopt a counter-cyclical approach. That is, as and when market is correcting, your net equity rises. There may be few products which have adopted a momentum approach where, like, as market falls, you try to reduce your net equity level. So I think the thought process which I like is a counter-cyclical approach because it helps you average out better as market keeps correcting, you keep increasing your net equity, and as market does well, you do some profit booking, you reduce your net equity level, and you shift to the other asset classes. So these are like broadly two basic methods of maneuvering your net equity level. Having said that, there can be the frequency of change can also vary. So there can be a daily rebalancing which is done and which can be a gradual increase or decrease. At times you can see a sharp reduction or sharp increase in your net equity level. Few products may follow that process. I think the preferred choice is a gradual method of increasing or decreasing net equity. So broadly, these are the two differences, but I feel most of them would be under the equity taxation, at least in the balance advantage fund, meaning that the gross would be at 65%. But the net can vary. So for example, it can go as low as 30% net equity, can go as high as 80% or even higher. So the variation can be quite high in terms of the net equity level.
Okay, so it could be very different. Mohit, let me ask you. I mean, so like I said, not all BAFs are equal. Yeah. So how do you pick and choose?
Look, I think broadly the style of picking, I think, is highlighted pretty well on that front. My choice still, Surbhi, would be a multi-asset fund for investors, basically, because they get the best of all the worlds, right? So I firmly believe in that approach that one size doesn't fit all, right? So you need to have some commodities in the portfolio to give it a good texture. We have seen at the start of our conversation today that how a little element of gold and silver could have really propped up your portfolio in terms of last 1 year, 6 month kind of returns. So a multi-asset gives you commodities, it gives you some element of REIT InvITs, it gives you some element of debt. And then it always will try and keep your equity between 50 to 65%. Again, you will have to select a fund depending on your choice as to what kind of equity do you want in your overall portfolio. If you want a slightly aggressive tilt, you will have to go with a 65 and above kind of equity. If you want a little moderate tilt, then you go with a lesser equity composition and higher debt and commodities.
But this is not static, right? I mean, if you pick a multi-asset fund, which right now might be having a higher equity exposure, but that could change when the fund manager feels the cycle has turned.
Absolutely, and that's the beauty of it all, right? The captain and the selector of the team will have to decide whether they want Varun Chakravarti or they want a pacer, right? Depending on the pitch and the market mood. So if they want to go 10% in commodities, which is the minimum stipulated regulatory level, they can. Or they can go 30-40% in commodities and reduce equity. It all depends on how dynamically the fund manager is doing the markets.
So as a mutual fund investor, what should I look for? I should back the fund manager who I feel is more adept, or because I can't stick to that. I want a MAF with at least 50% equity exposure, because that is not cast in stone, right?
I think the philosophy of the fund house or the fund manager will have to be understood before investing. Broadly, they will tell you that this is how we look at it and this is the range within which we can move. We will make aggressive movements, or sometimes the fund houses will tell you that, okay, no, we will always at all points in time keep 50% and above equity, right? So depending on that philosophy, you'll have to go, and you'll also have to see past record of asset allocation as to how they dynamically have they moved between the categories. Have they really shuffled across, or they've just kept a very static composition going?
That's a lot of hard work. So why don't you do it for us? We're almost out of time. So let's end this by asking you the most important question for all, which is the best hybrid funds to consider, including in the portfolio.
Look, if I have to choose a balanced advantage fund, I will go with Yahab's choice, which is a counter-cyclical choice, which is a true balanced advantage. If I have to go a slightly more technical choice out there, I'll go with an Edelweiss balanced advantage. On the multi-asset side, I'll go with a UTI multi-asset fund. If I want a very conservative multi-asset, I go with a DSP multi-asset. Or if I want a very broad platter of things involved, I go with a Nippon multi-asset fund.
Just quick reasoning on your multi-asset choices. Why that order?
No, it's in no particular order. It's just as to how I recall the names, basically. So I think UTI has a good composition of commodities. The performance has really stacked up, and they have shuffled the allocation fairly neatly. Same goes with Nippon. They have some element of REITs and InvITs also in their portfolio. The broad mix is pretty nice, right? DSP, because they are a little conservative in their overall approach on the multi-asset side. Their equity is not very high. So if you want a little conservative tilt on your multi-asset side, then you go with DSP.
Okay, all right. That's a quick crash course. We have lots of questions, but unfortunately, we're out of time. I mean, these are very technical aspects of, hybrid funds that we need to consider. But it's a start, at least. I think something for investors to think about. Thank you very much, Yahab, for joining us. And thank you, Mohit, for dropping in and explaining some of these very interesting funds to us as well. Well, with that, we're out of time on this edition of Let's Talk Money. Thank you very much for joining in. Keep sending us your queries and keep telling us what more do you want to know about. We'll take up that issue as a theme on the show in the coming weeks. Thank you for watching.
Let's Talk Money